Okay, we're going to go ahead and get started. So, good evening, everyone. This is How Money Works Masterclass Part 2. And this is where you'll continue to learn to stop being a sucker when it comes to your money. I'm Shantae Moore. I am a certified financial educator, and I'll be your presenter for the next hour. I just want to tell you, financial literacy, it continues here. So tonight I'll take you through the 7 money milestones. It's your step-by-step action plan. It's designed to help you chart the course from where you are today to financial security and independence. And the good news is that no one is too far ahead or too far behind to benefit from these milestones. So throughout this class, we'll continue to hear from the cast of How Money Works, Stop Being a Sucker book. There's a good chance that you'll relate to one of them. And trust me, you'll really understand where they're coming from as you complete this master class. And please feel free to make notes in the book. So if you have the book, feel free to make notes inside the book. If you don't have the book yet, actually just go to my website, howmoneyworks.com/Shantae Moore/book. And then you'll be able to actually request a copy of the book from there. So each milestone, it's very critical. They're all critical steps to reaching your financial summit. And because of this time that we're spending together, you're increasing your financial literacy concept by concept, strategy by strategy, learning to take control of your personal finances. And this will help you to gain the confidence to discuss your situation with a financial professional, which is what I strongly recommend, whether that's myself or someone else. No, and the first milestone, as we start the class today, is one that you're already on to completing, and because you're here tonight, you've begun milestone number 1, which is financial education, and that is the first part of this course. Masterclass Part 1. You're already becoming more financially ready with each page. Also, a financial professional is the best person to turn to for questions or details. I can discuss this with you again if you don't have someone that you could work with, or if you need help choosing a financial professional to work with. So basically, here's another way to say it. In the war for your money, there are 2 essential tools that you'll need to win. We know that the best starting point for everyone is to combine a financial education with a financial professional. Take this education seriously. You did not get this from school. Your parents didn't teach you about money, or your friends. You should treat your finances with the level of dedication that you put into your health. You can Google things, you can ask random people questions, but more importantly, I always harp on this on my channels and my videos, is that you should turn to someone that you trust who does this for a living, in particular, someone that is actually a licensed financial professional. And this is a time when you can't put everything that you've learned into action. This is the time where you could put all these things that you're learning into action with your financial professional. This person should be able to help you, assist you with crunching the numbers, charting your path, choosing products, staying accountable, and course correcting along the way, because some plans do need to change over time. Bottom line, I always tell folks, do not try this alone. Don't try to fix these things on your own. Work with somebody who has the professional experience and knowledge to actually help you. And remember what the Art of War author Sun Tzu said. He said, without local guides, your enemy employs you. Your enemy employs the land as a weapon against you. We all need a guide. And make no mistake, we're battling forces who want to take control of our money. So if you let them win, then you'll remain a sucker for life. So by finishing this course, by finishing Masterclass Part 2, and establishing a financial professional as your guide, you'll actually complete milestone number 1. So let's talk about milestone number 2, which is proper protection. And this is so important for so many reasons. For those who don't know, September is Life Insurance Awareness Month. So I've been talking to people nonstop about the important need for having life insurance. You need to protect yourself and your family from a possible future loss of income or savings, really, before you begin the rest of anything else with your finances. Like, this is the first thing to do. Because if you were to die prematurely, your family could be left alone, not only without your income, but without you. And a lot of times, if you have any savings, it's not enough to take care of that family if they no longer had you. So, though protecting yourself is more important than protecting your property, as Thomas Paine put it, you might not be able to fully protect yourself from illness or accidents. That's one thing that we can't, we don't have a magic wand for, but you can protect your income and you can protect your wealth. Ironically, a protection of your financial assets is called life insurance. It's a defensive strategy motivated by a sense of love, responsibility, or both. So how much life insurance should you have? And that answer is really different for everyone. So based on your situation, it's different for everyone based on your situation. So, however, as a rule of thumb, if we would recommend that you consider having life insurance coverage that is at least 10 times your annual family income. So, for example, if you earn $50,000 per year, you should consider at least $500,000 in coverage. 50,000 times 10 is $500,000. And at a conservative rate of 5% of a rate of return, which we talked about in Masterclass Part 1, that would actually replace half of your income. Let's look at a more specific calculation of your family's needs. And this is something that you want to do with a financial professional. So together with that professional, you can consider other factors like, number one, how old are you? How much debt do you have? What is your health status? Do you have any dependents? Or do you have adult children that you're taking care of? Or do you still have little ones like myself? If you have a business, if you're a business owner, let's think about what is your role in business in your overall financial situation. So many people like Dana here, she didn't know that 10 times her income was just the starting point. That's just the starting point. It's just a guideline recommendation for protecting her income. And it sounds expensive, but when you really need to look closer into it before you really decide that you can't do it, don't just brush it off. You might actually be pleasantly surprised with the actual cost of life insurance. And, and a lot of people really, they do underestimate how much life insurance they need. But on the other hand, they have a tendency to overestimate how much it will cost. And both assumptions can really keep families from putting proper protection in place. So eventually they just don't do anything. As insured.com says, only 59% of Americans have life insurance, and about half of those are underinsured. So you and your financial professional, whoever you choose to work with, again, whether it's myself or anyone else, they should cover some of these things. They should talk about your short-term and long-term debts and any other outstanding loans that you have. They should talk to you about your financial goals. They should talk to you about your mortgage, or do you have rent payments? They should ask you, how old are your children? How much of their education could you actually, that you intend to pay for their costs? And just like with so many things in life insurance, with all the options out there, it can seem very complex at first. But once you start to get educated and you start to know a little bit more, it does become very, very simple to understand. And to start, it's really just to understand that life insurance, it only falls into two categories. You either have temporary insurance or you have permanent insurance. That's it. Those are the only two types of life insurance. And for those of you interested, I'm actually going to be hosting a 30-minute webinar next Tuesday, September 22nd at 12 p.m. Central Standard Time, to do a presentation strictly on life insurance. And I'm going to talk about in more detail about temporary and permanent life insurance. But I'll touch on a couple of those things here on the next couple of screens. So first of all, let's look at term life insurance. And this actually provides coverage for a specified period of time. So like a 10-year time frame, or a 20-year or a 30-year. It's actually for a term. And term insurance is actually the most affordable life insurance available because it provides one core feature, which is the actual death benefit. And the death benefit is the money that's paid to the beneficiary when the insured dies. And because it expires after the term. So you're basically holding this policy only for that 10-year time frame, that 10-year term, or that 20-year term, or whatever term length you actually choose. And with term life insurance, it's possible to have financial protection for your family or your business with a very, very small monthly payment. That's why I love term insurance, because you can meet a substantial need, but at a very, very low budget cost. So this can make it fit for anyone with a limited budget during times of highest financial responsibility, like when you're raising your children, or you're trying to pay off debt, like your mortgage or college, or you're running your business if you're a business owner. So when you have that huge responsibility, term insurance will actually probably be a better solution for you in those instances. But what happens when the term on your insurance ends? Because remember, we said it expires at the end of the term. So there's two scenarios that we could look at, because just because that term expires, it doesn't mean your policy actually cancels itself. So scenario number one is this, is that you don't need coverage anymore. You can just simply let your policy end. No fuss, no muss. So if you have, let's say, for example, I have a 30-year term. My intentions of having that 30-year term was to say, well, while my children are young, and while they're still in school, while they're still relying on me, I'm going to have a term life insurance policy in place as long as I need until my children become young, self-sustained adults. Because at that point, they can take care of themselves. And if something happens to me, they'll be financially okay. But right now, while they're still young, they still need a significant policy coming from me if something were to happen to me. But once that 30-year term is over, my children will be grown adults by then. They better be taking care of themselves by then. So at that point, I don't need to keep the term policy. It served its purpose while my responsibility was still high. And then at that point, I'm just going to let the policy end. I don't need to keep it after that point. But what if after your term, you actually still need coverage? And you would still need coverage because maybe you're still paying off your home, or maybe you're a couple, but you and your partner only rely on one income, only one of you work. Or maybe you're actually still supporting your grown children or your grandchildren. We see a lot of multifamily units that operate in that manner. Or maybe you're still running your company. So for those reasons and many others, you might consider scenario two, which would be actually keeping your term insurance. So if you're in good health or your term policy has what we call guaranteed insurability, that means that you might be able to renew your old policy. But remember, if you want a completely new term policy, you would have to qualify medically again. So like, for example, let's say I'm 30 years old right now, and I have a 30-year term, and then I keep that until I turn 60. For me to keep a new, or to even get a new policy at that time, I would have to reapply as a 60-year-old woman, where my costs would be very much likely higher. And I don't know what my health status would be at that age either. But if you even can't qualify a new term policy at that point, it might not even be an option. But if you do qualify, the new policy, like I mentioned, it will definitely cost more just because you're so much older. In general, the older you are, the more expensive that new term insurance policy will be. So a lot of times people will say, well, Shantae, I'm 30, I'll get a policy and then I'll renew it when I get older. My pushback to them is, well, we don't even know if you'll be able to requalify once you get that age. So we could look at other options in case that scenario actually came up. So here I wanted to go through a quick concept. This is what we call the financial X wave. So in your younger years, which are represented in the blue on the left, you typically have more responsibility and less accumulated wealth. So you have little to no money, but a whole lot of wealth, a whole lot of debt. That debt could be like your mortgage, your kids, that's a responsibility. It could be a lot, you're responsible for a lot, but you have very little money coming in, which means you also have very little wealth. But in your later years, the yellow side of this drawing, the plan is that you should have accumulated wealth. Over time, you should have actually accumulated some wealth while at the same time decreasing your responsibility. So as you move to the right side, as you move to the right side of the X wave, You actually, over time now, because you're paying down your debt, you're actually saving more money and accumulating your wealth. So when you get to that other side of the curve, you actually flip flop, where you have more wealth with little to no debt. That's the prime scenario, but it doesn't always happen. So anyway, in this instance, term insurance is typically most useful when your responsibilities are higher and your wealth is lower, which is the left side. That's the blue side. You know, we're still young, we got a lot of responsibilities, but little wealth. And if these factors flip later in life, as we plan, again, we hope they do, then term insurance actually at that point becomes less practical. And so this is something that your financial professional can help you look at to see how can they apply the X-Wave to your current situation. So now let's look at permanent life insurance. Like term, it provides a death benefit to protect your family financially. However, permanent insurance is actually designed to be kept and protect you for your entire lifetime. Not just like a period, like a term. So hence the word permanent insurance. We intend to keep it until we pass away. So think of permanent life insurance as a lifelong strategy that can protect your family today. You know, we can really secure your wealth in the future and provide for your family after you're gone with a permanent life insurance policy. Oops, sorry. So a couple things here. So there are 3 important benefits of permanent life insurance. Now, first and foremost, number 1 is that you have life insurance protection for your entire lifetime. The second thing is with many permanent life insurance policies, you can also add long-term care as an optional rider. And number 3 is your accumulated cash value. So you actually can grow cash inside a permanent life insurance policy, which could give you the flexibility with paying into the policy in the future. Let's say, for example, if you, for whatever reason, you can't make your insurance premium payments, some of that cash value can actually pay your insurance premium payments for you. That's just an example. But other benefits that can be included with a permanent life insurance strategy, it can be advantages like absolutely no market risk. So I have a lot of clients who want to grow their money, but they're scared of losing it. This is actually a strategy, surprise, surprise, in life insurance that I would look at them to say, we can actually grow your money inside a life insurance policy and we never have to worry about losing it. And then you could also have long-term care coverage. So long-term care being that if you needed some type of assistance for rehab, or if you had a medical diagnosis and you wanted to get some care at home or a nurse to come visit you, that's what long-term care insurance will actually pay for. On top of that, you could also get tax-free growth. So that cash that's growing without no market risk, it actually also grows without paying taxes, which in the future can create tax-free income for yourself and ultimately leave a tax-free legacy to your family. Now, this is one thing wealthy people talk about all the time, which is avoiding taxes. Avoiding taxes is extremely important to consider because it can directly and significantly impact how much money that you'll live on in retirement, as well as the amount of money that you'll leave to your heirs. So let's talk about what that cash value component of permanent life insurance is and why it can be so important. So first of all, a portion of your monthly premium is set aside in an account that grows over the life of your policy. And the money in that account is your cash accumulation, and it can be used to fund future purchases. So you see a few possibilities here on the screen. So in addition to no market risk and tax-free growth, income and legacy, like we mentioned before, life insurance, the cash value in a life insurance policy can also be creditor proof, meaning your creditors can't come after that money at all. And when you look at all of them together, all these advantages, the cash value benefit is actually very, very powerful. Now, we saw that long-term care can be added to a permanent life insurance policy as a rider. So let's just talk about that, the importance of long-term care for insurance for a moment. I touched on it, but I really want to talk about it in more detail. So you guys might not know this, but 70% of people age 65 and over will need some type of long-term care services and support at some point in their lifetime. In other words, statistically, you yourself will likely need it. But here's the thing. only 8% of people over age 55 actually have purchased long-term care insurance coverage. And that sounds like a possible problem, a really expensive problem that's just waiting to happen. Long-term care insurance coverage, it really helps cover out-of-pocket expenses that can really add up. It can be used to pay for qualified services like nursing home care, home health care, assisted living care, or adult daycare. And you never know if or when you actually might need it. I actually have a client right now that I'm working with who, unfortunately, before working with me, they never had any type of long-term care insurance. They didn't want to implement it into their plan. The husband is experiencing some significant medical issues where he's been in the hospital, I think the last 6 months straight. And his wife is calling me. She was like, I want to move him to a rehab facility, but I don't have the money to do so. And the insurance that they have won't pay for it. And I just feel so bad because I talked to them about long-term care insurance and they were like, oh, we don't have to worry about it. That'll never happen to us. And they ended up in this exact scenario. So the husband is still in some type of hospital facility. And the wife is frustrated because she's like, I don't know what to do. I can't get him the care that he really wants. He wants to come home and be taken care of, but they just don't have the money to support that. So I know personally how important it is to get this long-term care insurance and to at least consider it. It's very inexpensive. And a lot of people think it won't affect them. I say just protect yourself in case it ever comes up. And here's the thing, if you ever need long-term care in general, the average long-term care need, if you have to get it, is more than a year. It actually lasts about 3.9 years. So like I just mentioned, my client, he's been in the hospital the last 6 months. He's not going to recover from his issues. He needs somebody to literally be with him day in and day out. And as you can see here on the screen, the average total cost, it can be crippling if you're not covered by a policy. The cost without long-term care coverage could drain one or more of your savings assets that you were counting on for the future. And a lot of times people say, I even met some wealthy clients of mine before, again, before we started working together. And they would say, oh, well, Shantae, I don't need to worry about long-term care. We got plenty of money. We'll just pay for it out of pocket. And I actually met a family who was doing that. They never got like long-term care insurance. And because they did have, I think they had at least over $1 million in their investment account, they're paying out of pocket, and they're paying about $9,000 a month to a facility to take care of their loved one. But had they got the policy that I suggested, again, that cost wouldn't be coming out of their pocket. They would actually be able to keep that wealth that they've accumulated and pass it on. And now they're actually paying and draining their wealth that they've accumulated. So there are a couple long-term care options that you can look at. The first is a traditional standalone policy. So it's like you go to an insurance agent and you say, I want to buy a long-term care insurance policy. And even if, again, you could do that even if you don't have life insurance, you could do that and just purchase what we call, again, a standalone LTC policy. Or what I recommend is that you can actually opt to add a rider to your permanent life insurance policy. And again, that's if it's available for the permanent life insurance policy. It depends on the insurance company, but you can add long-term care protection to the policy in the form of a rider for an extra cost. And that cost is very, very minimal. So for example, let's say your life insurance policy costs $50 a month. To add that long-term care rider, it might be like an extra $5 a month. So inexpensive. I try to have people qualify for it as much as possible. And that's the option that everyone should look into. So let's say you go with option one and you buy a traditional standalone policy. There are a few things that you should know. And that's like the fact that, first of all, the premiums, they will start low. But insurance companies actually can raise your rates on them. Also, you usually pay for care up front. You pay for care up front on your own out of pocket, and then you get reimbursed, which that can be seen as inconvenience, especially during a difficult time. Like, you don't want to have to pay for it and then wait to get reimbursed. Another thing to keep in mind with the standalone option is that you could spend thousands on premiums and get nothing back in return just because you didn't use it. I mean, although there is a 70% chance that you'll need long-term care, there's also a 30% chance that you won't. So you don't want to be in a position spending all that money and then ultimately you don't need it. Or you could go with option 2, and you could choose to add a long-term care rider to a permanent insurance policy. Now, this is a key advantage of this option. A key advantage of this option is that the life insurance companies, typically, they don't raise their rates for life insurance policyholders. Some insurance companies, after a waiting period, they actually may pay you money to cover the long-term care expenses, which you can spend however you see fit. So there's no need to, submit receipts once you become eligible for long-term care. Encompassing your life insurance and long-term care protection in one, that can actually save you a lot of money. So even if you're one of those lucky ones, one of the lucky 30% who don't ever actually need to use any long-term care, at least the money that you paid isn't wasted, because that money mostly went to a life insurance policy, and again, just a small bit went to the actual long-term care policy. And so instead, your family, they receive a larger tax-free death benefit. So long-term care riders, they aren't the only riders available when it comes to life insurance. You can also consider other living benefits like chronic and critical illness riders. That can help you save the day if you face any of the health challenges like you see on the screen. And you should discuss adding these riders to your permanent life insurance policy with your financial professional. Some are inexpensive, and some actually come with the policy for free that you can add. So again, I can help you with that if you need to look at some options for life insurance. And really, once you have milestone number 2 covered, I know that was a lot, but now it's time to tackle milestone number 3. So before I really get into milestone number 3, I want to make it very clear. Having proper protection with any plan always comes first. I have a lot of people who will say, well, Shantae, I want to invest money. Why do I need to talk about life insurance? Because your investments make no sense, because if something happened to you, they're going to have to sell it off anyway. And it probably won't even be a whole lot. So why not make the wise decision, apply for it, and get approved for a life insurance policy that we don't have to worry about the future? So enough about that. Let's move on to milestone number 3, which is creating your emergency fund. And if you ever talk to any financial professional, I know I say it all the time in all my videos, that any financial professional will recommend that you save at least 3 to 6 months of your annual income to prepare for any unexpected expenses like unforeseen medical bills, like home appliance repairs or replacements, or hassles just like having to get your car fixed. And don't forget the costliest of them all. What if you lost your job? So we want to talk about having an emergency. And trust me, I get it, because a lot of people are like, I'm living paycheck to paycheck. And if you're currently living that way, like many people are today, your emergency fund, it could be the insulation that separates you from financial disaster if something happens. I tell people all the time now, recently, if the pandemic didn't prove anything, it forced us to have to take care of our money, because a lot of people were not prepared for the results of the pandemic and losing their income or having their hours reduced and losing their jobs altogether. So I want to go through some examples here, as you can check out these sample annual incomes, and just look at how much money would you actually need to fit our 3 to 6 months income guideline. And again, these are just guidelines. It's not the end all be all, but again, just some guidelines. And TJ here, he has a good question. He says, and this might be something that you might be thinking of too. So where do you get the money to create an emergency fund? And the best tactic, especially if income is tight like it is for most people, it's just to put away a little bit of money, just put it away month after month until you reach your suggested goal of that 3 to 6 months of income saved. So think of it like a debt payment to yourself that you have to keep paying, that is due until you achieve your emergency fund goal. And here's some rules. So fund rule number 1. Your emergency fund is only for unexpected emergencies. That's it. That's all. It's not for gifts. It's not for getaways. It's not for buy one, get one sales. And it doesn't matter if it sits in your checking, your savings, or a separate account. Have it just put somewhere, as long as you're not tempted to use it for anything but a real emergency. Now, rule number 2 is if you need to use your emergency fund, let's say to pay for a car, to fix a car, or to replace the refrigerator, or to pay for braces, don't hesitate to use that money because that's what it's there for. Just make sure that afterwards you add some more money and add it back to that pile, a little at a time, month after month, until your emergency fund is full again. I can't tell you how many times I meet with clients and they're scared to spend their money, or they're like, oh, I gotta, I have to buy new tires and now I have to take money out of my emergency fund. I'm like, but that's great because that's what we set it up for. You needed to have that money set aside, because if you didn't, then you just would have reverted to a credit card. And that defeats the whole purpose of us getting our finances in order. Which leads me to topic number 4. So once you worked with your financial professional to square away your proper protection, to help you start establishing your emergency fund, now it's time to talk about managing your debt, which is milestone number 4. And I tell people all the time, before you can fully, and I mean truly, truly enjoy financial security and independence, you'll need to look at your spending habits and strive to reduce and eventually eliminate all your debt. And, I hate to say this, but in our culture, debt, it's a sweeping crisis, perpetuated by a society of suckers who are led astray, by the instant gratification and wanting to fulfill their instant desires of their generation. And that's a mouthful, but it's true. There's no shame in admitting that you struggle with debt, as it is one of the most common threats to having a sound financial future. But it's something that we have to face, and it's best faced head on with the support of a financial professional. The average American today has $28,900 in personal debt, not including mortgages, and many have much, much more than that. And don't forget about the other half of Americans who suffer from some kind of anxiety relating to their debt. When debt is removed, again, that's when we can only enjoy life more fully and more freely. And obviously, things have been hard with all that's been going on right now. So here are 5 quick tips to eliminate and stay out of debt. First of all, know what you owe. I can't say how many people they're like, oh, well, I got a credit card, but I really don't know how much I owe. I don't know what my interest rates are. You want to have a good eye on knowing exactly how much money you have in debt. Another tip, no more late payments. Let's pay these things on time. Go after one debt at a time. I meet clients and they're working on their debt. They're putting like an extra $100 here, extra $100 there. I'm like, let's put all of our extra to one debt and just get it knocked out. Stop charging and cancel all those unused subscriptions. Especially with the pandemic and everybody's at home, like we all have Netflix now, we all have Disney Prime, we all have these streaming services. Are these really needed? Or did we sign up for something like years ago and it's like $2.99 coming out of our account every month? Go back through all those subscriptions that we have and cancel the unused ones. Even consider refinancing your mortgage. Again, if you have a mortgage debt, interest rates right now are really low. It might be wise to actually refinance and get a better interest rate. So let's just dig into each tip really quickly, starting with know what you owe. Like I said, I suggest you just make a list of all of your credit cards, all of your debts, and all of your loans. It might sound tedious, and sometimes it is, but trust me, you'll feel so much better when you have your arms around these numbers and information. For each debt, write down your number and write down your dates. And then once a year, pull your credit report from one of the free online services. You go to annualcreditreport.com and just make sure that your credit report that is accurate and that is up to date. By law, every American has the right to a free credit report every 12 months. Again, go to that website just to get yours. And check the websites of the top credit reporting agencies for pointers on how to improve your score and report errors. Look for the word dispute. If there's things that you need to dispute them. And then here's the second thing, paying no more late payments. So paying after the due date, it really does hurt your credit score. And not only that, you can accrue late fees. So a good credit score can open opportunities to getting lower interest rates on loans like a mortgage. And there are 2 tips to paying on time. First of all, I would try to set up as much as possible any automatic payments, or you should consider setting alarms on your cell phone. Again, whatever it takes just to make sure that you are never late. And if you have balances on multiple credit cards, I always, like I mentioned earlier, just pay down the total balance on one card at a time. I personally recommend that you should pay off the smallest balance first, because we need to get you a win. Like, let's pay off that $200 credit card, knock it out, and feel good about paying it off. Or you can use the other method, which is to pay the highest interest rate balance off first. Whichever you choose, you should pay more than the minimum payment and as much as possible within your budget. And here, like in this example, you could start with card one, which has the lowest balance by far. And even though it has a higher interest rate than card two, then you could zero out card two, which has a similar balance to card three, but a significantly higher interest rate. And this is why writing down information about each of your debts was such an important step, because you're making decisions that will help you build momentum as you continue to eliminate your debt, each one at a time. And then as you pay off each debt, now you're freeing up extra income, but you don't spend that extra income anywhere else. You don't go out to eat all of a sudden or buy new shoes. You actually take that money that you were using to pay off the first credit card and the second credit card, and now you apply it to the third credit card. You need to use it to create debt elimination momentum by adding the money you were paying on all previous cards to your payment on the next one. And this will actually increase the speed at which you're paying off your debt and hopefully your excitement. So what you'll do is you continue to repeat this process until you're credit card debt free. And again, your goal is to have zero balances, but remember, don't close the credit card accounts. It's generally better to keep your paid off accounts open from a credit score standpoint. So again, you don't want to close those cards, just keep them open. So many people too, they just stop charging things to stay out of credit card debt by stashing their cards in a safer place. Another way to stay out of credit card debt is to use check cards and mobile pay, because that will pull your money directly out of your checking account. Something else also to consider is, again, canceling those digital subscriptions, like those online video streaming services that you don't use, and put that money towards your debt payments. And one way to lower your monthly mortgage payment is to consider refinancing, like I mentioned. Interest rates are really low right now, and this could actually help you free up cash to accelerate your debt payoff. And by paying on time, correcting your credit report errors, and then reducing your debt, your credit score will improve. And in time, you'll qualify for a better interest rate for a new loan on your home. And let's talk about milestone number 5. So increasing your cash flow is milestone number 5. And while the suckers, they gripe about how tight things are, the wealthy, they're plotting how to free up more cash flow. So this really does mean seeking out ways to earn additional income and figuring out how to better manage your expenses. So let's look at how we can do this. So first of all, cash flow, and the way I define it is, this is the money that you have available to spend or to save. And so after you've established, your proper insurance, having your proper life insurance, after we put together your emergency fund, after we have a plan to pay down your debt, now you're ready to zero in on growing your income. Obviously, the more income you have, it can accelerate everything that you and your financial professional are working toward. So you might feel like George, he's plumb stuck with his budget and finances. But after he took our class and learning about more options and ideas out there, now he really believes that almost everyone can find a way to get unstuck and create more cash flow. So let's look at more ways to get you unstuck by finding out how to get your, find new opportunities. So first of all, here's a few things that you can do to increase your cash flow. Create and stick to a budget. Develop a written game plan, and then also reduce spending, like spending money on car insurance or home insurance. And here's a few more. Reposition your savings. You can drop private mortgage insurance on your mortgage if you qualify. And your financial professional can help you guide you through these ideas and more. I like to go through these three big moves to supercharge your cash flow. Add a side gig. I tell people all the time, earning additional income is almost always a quicker way to reach your financial goals than just trying to spend less. A recent survey found that 45% of US workers, they have a side gig and that's earning them an extra $1,100 per month. And maybe it's time for you to get in on the action. Find you a side gig. Also, what about starting a business? There are lots of low-cost business opportunities out there. As Steve Siebold says, he's again one of the co-authors on our favorite book. He says that find the people that problem have and solve it. You could create a business by just solving problems. Become an entrepreneur part-time. You can leverage yourself time outside of your day job to do your part-time business. And as your income increases, a moment could be where you could actually transition away from being an employee to actually being a full-time entrepreneur, even with even more control of your cash flow. And I know that's something that I did. I used to work in a corporate position, in a corporate role, up until 8 years ago. As I started to build my financial planning practice, my income on my business now made more money than my actual corporate job. And I was actually blessed enough and in a position to leave that corporate job. Here's another thing, adjust your W-2 allowances. So some people, they get real excited when they get a big tax refund each year. And if that's you, I would just tell you, consider this, adjust your W-2 allowances. That way more money can come back to you in your paycheck all year long, instead of just one time when you get your big refund from the IRS. But of course, you want to talk to a professional before making those changes. But I know for me, like my goal when I did have a corporate job is I didn't want a big refund at the end of the year, because that meant that I gave the IRS more money, the government more money that could have went to me throughout the year. So every year I try to zero out. I try to have no money that I owe and no money that I actually have to pay when it comes to my taxes. So as we move along, kind of wrapping up to the end, I want to stick to the 1 hour time frame. Milestone number 6 is a big one, and it's really exciting. And I think when I talk to a lot of clients for the first time, this is what they're actually coming to me for: how to build their wealth. Building wealth it's really what people look as the bottom line of, their assets, their wealth. And this is actually where you also need to focus and have an understanding about other things to avoid to not impact your wealth, like taxes. We got to pay attention to taxes, inflation, losses in the stock market. We have to have a good understanding about the best way to accumulate and grow our net worth, especially with the possibility of longevity. Adding so many years to your life, people are living longer nowadays. So that really brings up one question: will your wealth last as long as you do? And you have to be able to answer that question. A lot of times people don't think way ahead into the future. They just think right now. You could still be alive and healthy and just doing very well at 80 or 90 years old, or even 100 years old. You have to think, will your wealth and your money actually live to you getting that age? So here, according to a recent study, 63% of people have a greater fear of running out of money in retirement than dying. And it's a real threat in this light of this eye-opening statistic. For retirement age couples, there's a 50% chance that one spouse will live past age 95. And then here's the crux of milestone number 6. So it doesn't matter. I'm not just talking about if you're older. It really doesn't matter what stage of life you're in. You have to start building wealth now. So put it another way: yesterday is better than tomorrow. So as you embark on thinking of, well, Shantae, how can I build wealth? What can I do? Well, first of all, there are 4 disciplines to help you stay on track and not lose ground. So I wanted to talk through these 4 disciplines so that you can start to save regularly and don't touch it, because that's the main purpose. Is we want to put this money aside, we want to grow it, and we don't want to keep touching it. And then you just want to review your goals and make adjustments as you need over time. And just like there are 4, disciplines, there also are 4 threats that every wealth builder must conquer. And think of these as your wealth building enemies. So each will come to you from a different direction, and to beat them, we'll have to address them individually. So let's start with the worst one, the worst one of all of them: procrastination. As one quote says, procrastination can be hands down our favorite form of self-sabotage. Um, you know, I have so many people, they tell me, well, Shantae, that's great. I want to invest my money, but I want to wait until after, my kids go to college, or I want to wait until after I pay off this debt, or I want to wait until I get married, or I want to wait until I buy a new house. That's procrastinating. People seem to think that there's a perfect time to start building wealth. For me, that's not the case. You just have to do it. And like I said, you just do it little at a time. It doesn't take a lot. Just start with something and just be consistent. And as your money increases, then start to put more aside. And then we start to pick apart market losses, inflation, and then, of course, taxes. Procrastination, again, is the enemy of saving and investment. It's best described as inaction. So really the tactic to overcome procrastination is just to prioritize. You simply move the 5 actions here to overcome financial procrastination to the top of your to-do list. These things are really urgent and you should start taking them seriously and start working on them immediately. You should never get lost, on the time that we've lost. Just think about the future. It's an asset that we all have in so many ways. That's our time. Stop doing that. Again, the 5 actions. Read the How Money Works book. If you don't have a copy of this book and you're watching this webinar, live stream or in person, or not in person, or Zoom with me, read this book twice. It gives you proper education and it shows you how to take action. Schedule a meeting with a professional this week. Again, I'm happy to offer my services. That's why I invite people, because I want you to be educated. But once educated, you need a resource that you could trust to help you through these processes. And set a goal for these deadlines, for each of these 7 milestones that we're talking about. And work on these milestones. Work with your partner, your spouse, a trusted friend, somebody to help keep you accountable. I tell people all the time, like, post your goals and your deadlines in your home. My bedroom mirror has so many little Post-it notes because I have so many goals that I want to keep in front of me and keep top of mind. So one thing I want to talk about, because a lot of people don't think of inflation as something that can affect our wealth. This is something that wealthy people pay attention to, which is inflation. And inflation is also known as the tax of time. So the annual inflation rate has averaged right at about 2.8% for the last 100 years. And so if you can actually approximate the number of years that it'll take the cost of goods to double at a steady 2.8 inflation rate. If you were part of my masterclass number 1, we talked about the rule of 72 here. The answer is almost 26 years. If you take 72 divided by 2.8, that means that one of the essential reasons to build wealth using the power of compound interest is to stay ahead of inflation. And when you know that this enemy is slowly devaluing your savings because the cost of goods is raising, it should drive you to even be more committed to growing your wealth. And don't let it scare you. You want it to let it actually drive you to action. I always tell people a perfect example of inflation is that $100 today will not purchase you the same amount of $100 of goods 10 years from now or 20 years from now. So your $100 today might be worth $100, but in the future it might be worth $80. That's what inflation is. And that's what we have to think about when it comes to building our wealth. Now, the next enemy to wealth building is the impact of losses. Often underestimated, but it's a threat that can wreck your savings goals and force you to adjust your lifestyle in retirement. So on the screen here, here's a simple picture that illustrates how many people miscalculate the impact of losses. So if you were to lose 50% of your investment, which this has happened twice now in the stock market in the last 20 years, back in 2001 and 2008, people lost half of their investment account value. What percentage of a gain would you need to get it back to 100%? A lot of people would say, oh, well, I need 50%. I lost 50%. I need 50% to gain it back, right? Wrong. No, it actually takes 100% gain after a 50% loss to get back even. And that's not easy to do, which is why it's so important to protect what you have. And maybe this is the reason why Warren Buffett, he's like the richest man in the US. He famously says about investing, rule number 1 is to never lose money. Rule number 2 is to never forget rule number one. So we want to be wise about where we invest our money and if we're put it in a position to where it could actually lose. So you like, Shantae, I don't want to lose money. Where can I put it if I don't want to lose? Well, first of all, there's different options that we can look at to reduce the risk. And then the second is just to figure out how to best diversify your portfolio. And third, utilize the right financial vehicles for your situation. You know, a lot of people just like, oh, well, my best friend is doing this, so I should do that. No, we want to look at what's the right thing for your situation. And remember, don't procrastinate. You know, remember inflation. The longer you take to actually start putting money aside, you're procrastinating, you're pushing all your goals off, and you're not helping yourself at all. Trust me, it's not like all of a sudden in the future you'll invest a whole bunch of money and it'll just work out. It's not how it works. So this is where you really want to talk about with your financial professional about ways to reduce or remove or completely consider the impact of losses from your strategy. There are ways that you can save your money without having to take on losses. And again, that's something I could talk to you about this if you're interested in learning. And so, and last, the impact of taxes, the 800-pound gorilla of wealth building threats. When you're preparing for retirement, the tax strategy that you put in place today can determine how much money you keep, how much you pay the government, and then ultimately how much you leave to your kids. So it's so important to make sure you choose the right type of account that you're putting your money into. And understanding how these different type of investment accounts can be taxed can really help you make either a really bad decision or a really good decision in the future. So let's kind of go through a couple of these accounts. Let's go through a quick example. So let's say you're 29 years old and you are saving $10,000 and you find an account that earns you 9% interest as an annual return every single year. So you would actually have $250,000 when you reach retirement by the time you turn age 65. So let's think like a farmer for a second. Would you rather pay taxes on the seed or the harvest? You know, of course, whichever is smaller, right? Whichever, which is usually what you start with. A farmer would rather pay taxes on the seed, not the harvest. An investor would rather pay taxes on the money before it grows, not after. So you either pay taxes now, you pay taxes later, or you pay taxes never. My favorite bucket, the tax-free bucket. Now, which one should we apply to you? It really depends. It depends on the vehicle that you choose. And again, this is where you would talk to somebody like me. So that if you're saying, Shantae, I want money in that tax never bucket, great. I can show you options to put money in a tax never position. So you want to get some professional help for these things. And when you sit down with your financial professional, they can help you figure out what you're being taxed on now and what strategy you can use to move forward. And the color of the icons matter, right? In this example, so red is a tax now account. Yellow is tax later. The decisions, they get simpler when you break it down to these categories and colors. You know, think now, do you have any red or financial vehicles or yellow financial vehicles as you see here? If so, now you know how you'll be taxed. Let's look at green. So green is the color of money and growth. It is also our color for those tax never buckets, those tax never accounts. And different types of accounts, they can be taxed completely different. The green icon, again, it just means no tax at all. And I love green. It looks so good. Are there any tax never vehicles that you have a part of your current strategy? Again, this is where you want to sit down with a professional who can help you pick out the right products for you. And the boxer Mike Tyson said, everyone has a plan until they get punched in the mouth. So I did hear he's considering coming out of retirement, right? He's in his 50s now and he hasn't boxed in more than 15 years. So maybe he should listen to his own words. The best way to avoid running out of money in retirement is by not putting yourself in the position for it to happen to you. So in other words, just stay out of the ring. I have about 4 minutes. I'm just going to skip real quickly to milestone number 7, just because I'm running out of time and I want to keep the last couple of minutes to talk about number 7. So my apologies. Again, if you don't have a copy of the book, message me and I'll get that to you. But I want to talk about the last milestone, which is protecting your wealth by creating a will and guarding your legacy. And this is even something that the rich people, they miss sometimes, that they don't do. Like my favorite pop singer, Prince, and our queen of soul, Aretha Franklin. Both of these people just died a few years ago. They were amazing musicians. They had multi-million-dollar estates, but neither of them had an estate plan. Both of them left their families and business partners with an emotional, financial, and legal mess that's still being sorted out right now for both of them. So this shows you how important it is to protect your wealth with an estate plan, according to a Rocket Law, with an estate plan. According to this Rocket Law survey, 64% of Americans don't have a will. And not surprisingly, the number is higher for younger Americans, 70% of those who are 45 to 54, than older Americans that do not have a will. And Prince, he himself was only 50, what did it say? He was only 57. So, and your estate plan is how you protect your wealth, your family, and your legacy when you die or if you're incapacitated. It's the first set of documents, including your will, used by your loved ones to carry out your wishes and your decisions. I just want to tell people it's 2 minutes to the hour. I'm actually probably going to keep going. I don't really want to cut out this part because this is actually my favorite part to talk about. So for those who are joining me on the live streams, thank you for tuning in. If you have to jump off, I totally understand. But I'll probably go, I think I might have another 5 or 10 minutes. I really don't want to cut this part short. So I want to talk about these 4 documents in your estate plan and what your plan should include. You'll need a will. You'll need your financial power of attorney. You'll also need an advanced healthcare directive or a living will, and you also need a HIPAA release. And this is something that a legal professional can help you put all in place. I have some resources, so if you don't want to use a lawyer, I use an online estate planning company to help me and my clients with when it comes to completing their estate plan. And the reason why I'm so passionate about this topic and having an estate plan is so important is because it helps you avoid the government from making decisions about who gets your property and who takes care of your children. And the process for in a court to get involved and administer your estate, that's actually called that's called probate. So if you ever hear the term probate, that's because that's the court who's now administering what happens to your money. And nobody wants to go through that if they don't have to. Trust me, a lot of people do not like having to go through the probate process. So you can actually help your family, and if you have business partners, because you don't want to be in business with someone and then all of a sudden you're gone, like what happens to them? But anyway, you and your family, you can help your family, your business partners avoid unnecessary expenses and delays because they're dealing with the probate process. Just by having one estate planning tool that I love to talk about is called a trust. And trust can do many things for you. Again, your legal professional can also give you the best advice when it comes to trust. But a couple of things that's listed here is it manages your property if you no longer can manage it for yourself because you're physically or cognitively impaired. It protects the interests of your children. It protects your special needs children. I think that's very important because but if you're a single parent and you have an autistic child and you know how to take care of that child, but what if something happens to you? Who's going to take care of them? It also provides privacy. So like right now, because Prince and Aretha Franklin did not have a trust, actually everybody can go in those court documents and see all their papers and everything that's going on with their estates right now because they didn't have a trust. Also, it can help you avoid probate in many, many states. So a lot of times, depending on where you state, your state will say, oh, Shantae had a trust, so we don't need to get involved. We don't need to do a probate process. And then another thing a trust can do is possibly lower your estate taxes and provide tax advantages for those larger estates. So if you actually do have a significant amount of wealth, we can, manage our tax consequences by having a trust as well. And then keep in mind that some assets do pass directly to your beneficiaries at death, and those are neither transferred through a will or a trust. So basically any account that has a beneficiary listed, things like life insurance, an annuity, an IRA, a 401k, any retirement plan at the workplace, If any account, whatever account it is, if it has a beneficiary attached to it, that will actually go straight to the person. It will not go through the courts. It won't go through anyone. It can't be disputed. It goes straight to that person. You can even probably contact your bank, because some bank and investment accounts will also allow you to add a beneficiary. So sometimes people say, well, Shantae, what can I do right now? I want to protect my assets. Maybe I can't do my will or trust right now. I always tell people, put a beneficiary if you can, if the financial institution or an insurance company allows it. Identify and name beneficiaries on all of your financial accounts if you could. And then if you own a joint account with another person, that account would actually transfer right to that other person. It'll go right to that joint owner at death. And if you think estate planning is too expensive or too time consuming, then you really not haven't considered, how these things can actually impact your loved ones. And the truth is, again, like I mentioned, there are options for almost every budget. And I recommend that you put this milestone in place right away. Like I said, I have an online estate planning company I work with. To be honest, they'll offer you everything that I talked about here for just $100, just for $99. If you want the trust, it's a little extra, but $99 to get all of these plans in place is very inexpensive. And that company is who I use for my estate planning. I'll be happy to share that information with anyone if they want to learn more. So as I wrap up here, again, I did go a couple minutes early, almost finished. Just think about what concept really resonated the most with you. And that's why, I've been on my mission for eradicating financial illiteracy. If you've been following me a long time, maybe you're on my email list, maybe you follow me on YouTube, you know that that's my message. I want people to be educated. I want them to be financially literate and smart. And this is how you start to take control of your finances. So here on the screen, this is an example of a worksheet that we call it the money discovery. And this works like driving directions on your mobile phone. You got 2 points of reference is all you need, where you are and where you want to go. And the same is true to chart your course for your financial roadmap. And the How Money Works Money Discovery in the book. It's the last 2 pages, I believe. Where is it? I'll pull it up while I'm talking. Here it is. So in the book, you actually have the How Money Works Discovery in there. So I suggest that you complete the worksheet that's in the book, or if you want a PDF copy of this document, I can actually email it to you. Again, contact me. However you got here, you know how to reach me. Contact me and I'll be happy to email you a copy of this worksheet so that you can fill it out and work with your professional. Again, I'll be happy to be a resource, or whoever you choose to help you with your finances, so that they can make sure that you're on track to reaching your financial goals. And if you currently don't have a financial professional to turn to, the first 7 money milestones, again, it's financial education. Since you've hopefully read the How Money Works book, you've already started down the path of learning how it really works. And I can help you walk you through the other 6 milestones. And I normally do that in 2 ways. So I know I've said I can help you. You can contact me, right? So this is how I do it. So the first step is what I call a discovery phone call. And this is where I'll spend about 15 minutes identifying where you are in your financial life. And then most importantly, where you want to go. And then I'll collect some data from you, and then me and my team will spend a few days crunching some numbers, searching through the financial industry to find you the best product and service to meet your need. And then I'll identify the ones that best fit your current situation and that will help you best get towards your future goals. And then what we'll do is we'll have a solutions appointment. So this is where we will have a screen share just like this. We'll have a Zoom meeting. And I'll walk you through the steps of those recommendations. So I'll say, hi client, you had a budget of, $500. This is what you should do. You should put 200 into this life insurance. You should put 100 here into this investment. You should put 100 into this estate plan, whatever it is. These are all hypothetical, but that's when I will take that budget that you gave me and I'll actually walk through the solutions to say, okay, this is what you should do. This is why, this is the goals that it'll help you with. And then that way you're educated on the recommended steps that I'll be giving you to achieve your financial goals. Okay, so I'm only about 6 minutes over. We're at the conclusion of today's session and the entire How Money Works Masterclass. And you know, milestones like you just learned, they will bring up questions like the ones that you see here on the screen. And again, this is where a financial professional is the best person to turn to for questions like these and others. Again, I can discuss these with you. Unfortunately, I won't have time. I won't be able to take Q&A like I normally do on these classes because I'm a little over. But again, however you reach me, you know how to connect with me. So we can discuss this, or if you don't have a professional to work with, I can help you choose one. For me, sharing financially literacy and educating, that is exactly what I do. So thank you guys so much for your time and attention. And I wish you all the best on all of your financial endeavors. Bye now.